Pete has extensive investment management experience, including the position of VP and senior market strategist previously at Curian, and then also he was a senior vice president and portfolio strategist at Global Financial Private Capital. Now he fills that role at Clark Capital. With us also is our internal and Jack McLean and Ryan Schmideker. So we thank you guys for your time. We have a lot of expertise available to you folks. So Pete is a shareholder of the prestigious, very difficult exam process of the Chartered Financial Analyst, or CFA. Very, very tough program to get through, which requires several years of dedication. He received his MA from Johns Hopkins University School of Advanced International Studies here, more or less locally, and a BS in Commerce and Finance from Santa Clara University. So we're going to do kind of a Q&A session. There might be some slides we'll throw at you, depending on if Pete needs to do that or not. It's up to him. Within many of our managed accounts at Clark, we're primarily using three of their strategies, and they all tend to be high yield corporate bond tactical strategies. So we use the Navigator multi-strategy approaches. There's several of those, the tactical fixed income and fixed income total return strategies. So Pete, it seems to me that currently we're in somewhat of a new economic and financial environment. A couple of weeks back, Treasury Secretary Janet Yellen said in an interview on CNN with Wolf Blitzer that, quote, "I was wrong with the path inflation would take." So that's a big admission. And then the following week, St. Louis Fed President James Bullard came out and piled on, said, "I think we're on the precipice of losing control of inflation expectations." And last week, Jeremy Powell, Fed chairman, came out and said that inflation is not the Fed's fault. Well, one can try to duck under the COVID umbrella or supply chain issues, but after printing 50% of all dollars ever created in just 2 years, the big elephant in the room is, of course, excessive monetary stimulus. That said, Pete, do we need to worry about inflation?
Yeah, well, first, thanks for having me here today, Bob. Appreciate the chance to get to talk to some of your clients. And yeah, when we think of inflation, I mean, it'd be, I think, kind of foolish for me to say it's not something to worry about. We all know that when we go to the store or fill up our gas tank, I know I just did this over the weekend, we're seeing what those numbers are. And they're just numbers we haven't seen, in years and years. We're seeing the highest inflation readings we've seen since the early 1980s. So we're talking, 4-decade highs in some of the inflation data. What I would say, Bob, is we are of the opinion at Clark that we do think the inflation numbers will start to improve as we go through the balance of the year. We think part of it was supply chain issues. Part of it was, yes, a lot of really inexpensive capital available in the system. But we know the Fed has tools to try to combat inflation. When you look historically at the Fed during periods of higher inflation and they start to raise rates, they've had a pretty good success, pretty good track record in bringing inflation in. So we are seeing this. I'm sure everybody is aware. We are in now this rate hike cycle, and the Fed has raised rates 2 times this year. One time they did it by 0.5%. We would say 50 basis points in our lingo, but we have moved a clear direction away from where we were last year, where the Fed was buying bonds on the open market, kind of keeping interest rates really suppressed. They were keeping their Fed funds target rate at 0 to 0.25%. Now we're shifting. Now the Fed is obviously no longer buying bonds, and they're raising rates with that single determination to try to slow inflation and slow those inflation expectations. I know I was just looking at a few days ago, maybe it was last week, some of the 5-year forward inflation expectations, and they have started to roll over a little bit. Doesn't mean they can't go back up, but we do think the Fed will have some success. We think we will still be in an elevated inflation environment, probably through the balance of the year, but we do think inflation will start to improve, meaning get lower as we go through the balance of 2022.
Terrific. Well, with raising rates, you believe that is raising the probability of an inflation, or I should say a recession, either this year or early next year?
So, it's a great question, Bob. And one of the things we've seen historically is, I promise this will be the most technical I get with you all today, but that we have seen this, what we call an inverted yield curve, prior to every recession we've had since the late 1960s. And so when we think of the yield curve, it's really from short-term rates, we can even say overnight rates, to like 30-year rates. And we tend to look at the 3-month T-bill compared to the 10-year Treasury. And that's where we have seen that go inverted prior to every recession since the late 1960s. We've had a couple times we've gone inverted and have not had a recession, but the recessions we've had since the late 60s have been preceded by that inversion of that 3-month T-bill and the 10-year Treasury. So where are we at? During the first quarter of this year, that actually ratio got a little steeper. The three-month and the 10-year actually got steeper. I'm sure a lot of people might have heard the news of the 2-year Treasury and the 10-year Treasury did invert. It inverted for a couple of days. And so that made a lot of news about, is this inverted? Have we had the inversion? Maybe, maybe not. We do think the 3-month and the 10-year has a little bit more kind of meaning when we think of what it reflects when we look at the economy. But to your point, Bob, why do those short-term rates go up? Well, the Fed actually has quite a bit of control on that very front end of the yield curve. If we think of that Fed funds target rate, they're raising, overnight type rates, and that gets reflected, pretty clearly in that very front end of the yield curve. So 2-month, 3-month kind of T-bills, we see those move up. And what tends to happen if we're in this rate hike cycle is, does the Fed overdo it? Do they raise rates too much and bring in economic activity too much that leads us into a recession? That's where you might hear people say, boy, this is a tough kind of needle to thread. I mean, it is a tough needle to thread for the Fed to try to slow inflation, which means slowing some of that economic growth, right? Reducing some of the price pressures in the market, bringing down demand a little bit in the market to try to reduce those inflation pressures, but do it in a way where we're not getting kicked into a recession, where we slow economic activity too much and we go into a recession. So, the recession question, our perspective is we don't anticipate a recession this year. We would say the probability is pretty low. And I say that with full knowledge that first quarter GDP was negative. We know the second quarter, the estimates aren't very strong on the positive side. So, that's kind of a technical definition a lot of people use as 2 consecutive quarters of negative GDP. But I would also point out something like we're at 3.6% unemployment rate. That doesn't feel like a recessionary environment if we have such a strong job market. And I'm sure you've all heard we've got millions of more jobs available than we have people looking for jobs right now, which creates its own issues. That can be inflationary in and of itself, but a much different picture than where we were, for example, during the credit crisis, where you had, I think it was 7 or 8 to 1 people looking for a job for that open job. Right now, there's millions more open jobs than people out there seeking jobs. So we are looking at that closely. We would say probably we'll watch what the yield curve does. We'll watch to see how aggressive does the Fed get in this rate hike cycle, where when we step back, they've really only raised rates twice, and by 0.75%. So they're in the very early stages of this rate hike cycle. So we'll watch that as we go through the summer and the fall to see, do they really start to raise rates rapidly? Has the market done a lot of that kind of repricing of bonds already? Has the market done that for the Fed? But that's what we'll look at to say, is that a more likely event as we get into 2023 or the later part of 2023 when we think of an economic slowdown or an economic recession? That's not our base case as we go through 2022. We still think we're in an economy that will grow as we go through this year.
Okay. Well, Pete, the last 13 or 14 years have been fairly unusual in that we've not had a substantial number of defaults in distressed debt or bonds for you clients. Do you see more bankruptcies over the next couple of years, given that cheap money has really kept some what we would call zombie companies alive? And what has Clark been doing this past year and going forward to minimize losses in a tough market?
Sure. And I think, hard for me to kind of say, what do I think will bankruptcies pick up? But I will say this, Bob, I think it's a really good question in that, and I think we were agreeing on this point. I mean, money's been very cheap. I mean, capital has been very cheap over the last couple of years, and that is the Fed when they were out there buying bonds and keeping interest rates low and putting a lot of capital availability in the system. So we were and are kind of changing now to an environment where capital is getting a bit more expensive. So I think it will, to a degree, expose those companies that really are, don't have the financial strength to kind of go through a higher cost of capital environment. So we'll have to see how that plays out, Bob. But yeah, I do agree that their capital is getting more expensive. The financial, again, it's getting a little bit more restrictive when we think of where monetary policy is right now. So that really will show what are companies still able to raise capital? Are they able to do it at a price that makes their business still viable? So those are the things that we'll see as we kind of go through the next couple of years, or maybe I should say more through this rate hike cycle period, depending how long that'll last. Now, to your second part of the question, probably more importantly for clients. So we look at high yield bonds in a couple different ways. So won't spend much time. We do have kind of individual bond portfolios where we are selecting individual bonds, and that's kind of roll your sleeve up type of management, where we're picking the bond we want to have and doing the fundamental analysis on those bonds and those companies. What I think the way Bob uses us a little bit more on our fixed income approach is our more tactical fixed income approach, which does use high yield bonds as one of the categories of bonds we can be invested in, but we can get out of them if we want as well. So we really use a disciplined, quantitative approach where we're really looking at price action in the market, and we're looking at how is high yield bonds, how are they doing compared to other categories of bonds. And we think of kind of high quality bonds in another bucket, and those tend to focus on things like treasuries. And then in a third bucket, we look at really short term, kind of short dated, we would say cash equivalents. It's not cash. I always like to be clear. It's not cash, but it's, really short duration things that are exposed to like T-bills and those kind of areas of the market. So we can look in the market. So we'll say, what is the market rewarding more? What's it rewarding less in the current environment? So at those times where we see high yields start to fall out of favor, we can move away from it. And so that is really that approach with a tactical strategy is we will be in high yield when the market conditions tell us that, hey, we think there's more opportunity in high yield compared to those other two buckets of fixed income. But when that trend changes, when that trend does turn, we can get out of high yield. So that's kind of our approach there. So, to your question, Bob, we can move out of it. I mean, that's the way, if we're starting to see a deterioration, seeing that based on price action in the market, we can get out of high yield in our tactical strategies and get into that high quality kind of treasury focus bucket, or into that cash equivalent, really short term kind of T-bill like exposures in that other bucket.
Cool. So this year, 2022, my understanding is that you were largely in, say, mid-risk or low-risk investments for these tactical accounts, and then recently you went back in to the high-yield bonds. Is that correct?
That's right, Bob. So we came into the year in that high-yield bucket. At late January time period, we got 50% out of that high yield. So we were kind of in that 50-50 posture through then most up until May. And then we actually did do a full de-risk off for a brief period, but then did start to go back risk on. And yes, kind of coming into June, we are now back in that high yield exposure in that tactical strategy. And again, we'll continue to monitor as we do. What are the indicators telling us? Do we want to remain in there? Or if things start to deteriorate and we think it's necessary to get out, we can get out of that. But you're right, Bob. As of this point, we are in that high yield exposure.
Terrific. Okay. Well, getting to stocks for a minute, this market has tended recently to appear to be leaning towards a value base, meaning we have two types of stocks very broadly speaking: value stocks, growth stocks. The growth stocks have really been hammered during this correction. Value stocks, not so much. Do you think value is going to retain the trend line for a while, or are the growth stocks going to come roaring back after this interest rate cycle pans out?
Yeah, it's a great question, Bob. And this is something we have talked a lot about over the last couple of years, because on the other side of this, when we think of 2018 and 2019, and really parts of 2020. We know we kind of went through the pandemic and the big sell-off period there, but we were in a period where really growth was dominating value, and we were at those points and some of the periods during that, we thought the disparity between growth and value was really getting stretched, really getting extended. And we thought, at some point value, some of that disparity would start to come in. Really, and again, I said I wouldn't get too technical, but one of the things that is interesting that some people don't realize is what happens in the bond market does affect the stock market as well. When we think of a growth company, they tend to be what we call more of a longer duration asset. And I know duration is kind of a fancy word, but duration we generally talk about in fixed income, and it kind of relates the sensitivity of a bond to interest rate movements. And one of the things we observe is that growth stocks, if you think about a growth company, I'm tending to pay up a little bit more. They tend, again, I'm generally speaking, have a little bit higher what we call price to earnings ratio, or a multiple, we would say. And what you're when you're investing in a growth company, you're more concerned about what are they going to earn in 3 and 4 and 5 years versus are they going to pay me a dividend in the next quarter? That's usually not the growth world. So when you're in periods where interest rates are rising, like we've been in really since kind of late 2020, that can have a bigger impact on growth companies because they are a little bit more duration sensitive. So interest rates have been going up, and that growth area has been coming down. I mean, it's been really dramatic this year, Bob. The relative outperformance of value, yes, value is down as well, but we've really seen growth come under a lot more pressure than the value parts of the market. And so, we know this year has been a year where interest rates have gone up pretty dramatically, through the first 5 or so months of this year, and that has really had an impact on growth companies. Now, a couple final points, and we can dig into it more if you want to, Bob. So again, on our kind of tactical strategies, again, I think where, Bob, you're using us more in portfolios, we kind of can look around what we call a style box. And so we can look at growth, and we would say blend is kind of a blend between value and growth. So growth, blend, and value, small cap, mid cap, large cap. And we can kind of be looking in that style box. What areas of the market are doing better? What areas are doing worse? And here we're going to use price action again to kind of determine that. So we can lean into different parts of the market and move away from different parts of the market as well. So that is a more tactical approach that we have in that kind of tactical strategy, where in that style, approach to it, we can kind of move around that style box on where we are seeing those opportunities. Now, in our individual stock portfolios, we have individual stock portfolios as well. I kind of like to say we do have a quality focus. And now you're saying, wait a second, we've talked about value and growth. What's quality? We think quality can be in value and it can be in growth. It can be in either of those two styles, but we do look for what we think are higher quality companies. We want to get them at the right price, and we want to see some improvement happening in that business is generally what we're kind of big picture looking at for the individual stock side of the portfolio. And as I said, those can be, they can fall into the value universe or they can fall into the growth universe. So I think, Bob, we'll have to watch, where do interest rates go? I mean, we'll have to see if interest rates, and again, our opinion at Clark is we do think we've kind of had a big part of the interest rate move higher has occurred this year. We do think rates will likely trend lower as we're going through the balance of the year. Doesn't mean we won't have a period where rates might move up again, but we think generally the trend will be rates going lower as we go through the year. So we'll watch that, and we'll start to see how does growth react to that environment as well. So again, the disparity between value and growth really got to such an extreme, we thought, kind of in late 2019, in part of 2020. We do still think there is opportunity for value to continue to kind of close that gap, but it doesn't necessarily mean in the context where growth has to do poorly and value as well. If we're talking in a relative world, we still think there's opportunity in the value side because of how extreme, the disconnect was between growth and value really prior to the pandemic when we looked at the way those styles were running. And this has been a better period for value. We'll see how interest rates go through the balance of the year. We think they will come in. And again, that could more generally provide some opportunities in both the growth and the value side of the universe.
Terrific. Before this life, I spent a good bit of my early life working internationally and in third world countries. And so I've developed a high sensitivity to dollar denominated debt issues, having lived through a multitude of dollar disasters. Well, currently, dollar reserves seem to be declining. And in the past, when that's happened, a financial crisis somewhere on the planet has resulted, leading to difficult times everywhere. With this apparent starting of a dollar shortage overseas, is it time to buy, or is it a time to lighten up on international stocks?
Yeah, so the way I approach that, Bob, and let's talk about international stocks. We know, again, generally speaking, they have underperformed the U.S. for most of the last 10 or 11 years. I think it's like 9 of the last 11 years or something. U.S. has done better than international. Well, the way we look at international is, we do think, again, in most client situations, generally looking at portfolios, international is an important part of a diversified portfolio. So we do think international stocks, have a place in most client portfolios. And again, that can change client by client, but we do still think there is opportunity. If we think of why are we seeing, or what opportunity are we seeing, a lot of times it comes down to valuations. Valuations in the US up until this year, I would say, over the last couple of years, they've been a little bit above their historical averages. When we look at kind of the PE ratio, again, that price to earnings ratio of the general stock market, it's been above its historical levels for the last few years. We can get into that a little bit more, but what we're seeing internationally is, better valuations. And I usually like to say in the same kind of sentence, do we deserve a premium in the U.S. with our capital markets and the dynamism of our economy? Yeah, we probably earn a premium when we think of valuations, but it doesn't mean there's not opportunities internationally as well. So we do have an international portfolio, and when we look at international, in kind of that bottoms up individual stock world, it is, hey, there are opportunities out there, and part of it is valuations. We tend to see better valuations internationally than we do, or we have of late in the U.S. And again, our valuations have improved because we've had this decline in stock prices so far in 2022. But yeah, the timing is hard, Bob. My crystal ball is as good as everybody else's, so it's kind of hard, when do you go in or out? But I do think, and what I'm comfortable saying is, we do think international, generally speaking, is an important part of a well-diversified portfolio for clients. And that's kind of how we generally approach the international side of it. And we know the dollar's been really strong of late. That's another headwind to kind of those non-dollar, investments that you have if the dollar is really strengthening. So there's been a few headwinds on that. We know with the dollar strength here of late, but part of an overall portfolio, we do generally think international does have a role in that well-diversified portfolio.
Well, let me ask you, that makes me think about the dollar. It's been expensive, relatively speaking, to most of the major economies for a long time now. The whole planet is in debt to a remarkable level. Do you foresee the dollar maintaining this relative strength versus the euro or the yen?
Yeah, and I know of late we've really hit some kind of multi-year type of highs against the yen and the euro. We're kind of close to those with the dollar strength. And why is that? I mean, my answer to why is that happening now is we're in a rate hike cycle, right? We're at a period for a couple of years where the Fed kept interest rates really subdued, didn't want interest rates to rise, wanted that capital to go into the economy and into the system, didn't want people saving it. They wanted people to be out, generating economic activity with their money. But as the Fed starts to raise rates, that can make the dollar, relatively more attractive if now we actually have some higher rates, that kind of those foreign dollars can flow into, or foreign denominations can flow into. So I think as we're kind of in this rate hike cycle period, and other parts of the globe could start rate hiking as well. We'll have to see what the rest of the globe does, but that does seem on that relative basis, which is really how you look at currencies, kind of relative to each other. It does seem to argue, or it seems to provide a pretty good explanation on why the dollar has of late really even gotten a little bit more expensive compared to some of those other denominations, because the dollar, we are in a rate hike cycle now. Interest rates are higher, so that does make the dollar a little bit more valuable when you think of that global, currency backdrop. So we are still in kind of those early stages. I do think we'll likely continue to see the Fed raise rates through this year. We'll kind of see how aggressively they do it. Do they do 50 basis points at their next meeting here in a couple of weeks? We think that's likely, maybe even another 50 basis point move. But if they start to talk on the margin, if we start to get a little bit of improvement in some of those inflation readings and the Fed starts to talk a little less hawkish, we'll see if that kind of changes some of the dynamics in the currency side. But it seems to make sense from my perspective, at least, why the dollar is so strong right now compared to other global currencies. And that really is, I think, kind of recognizing that we are in the beginning of this rate hike cycle here in the US.
Okay. Well, do you have a question?
Pete, I do have a question. We've got a variety of different clients in their retirement journey, some getting ready in the next few years to retire, some that just recently retired kind of right when COVID happened, and then some deep into retirement. If you could speak to them on kind of what you're seeing and maybe suggestions in their different journeys, what they should be doing in the market, or kind of best practices on your end?
Sure. No, yeah, that's a great question. Maybe it's a good chance for me to talk a little bit about Clark in that. So we at Clark only work through advisors like Bob and his team. So you can't come off the street and say, hey, Clark Capital, will you manage our money? That's not how we work. We work through financial advisors. And to your point, the reason why we do is we know that financial planning side is such a critical element to meeting your longer term goals and objectives as clients. And there might be some clients that, hey, for that client, it makes sense to be 80% stocks, 20% bonds. And for the client right next to you, may make sense for them to be 20% stocks and 80% bonds. That's really what we think is an important role of the financial advisor, of Bob and his team working with you. Those aren't calls that we make as we look at it. We try to then implement, to the best of our ability, those kind of directions that we get from Bob and his team on how do we manage the money for this particular client? What are the right asset allocation that we want to look at, and how do we invest that for a client? So a couple of my big points, and I think I like the question because I like to tell clients, a couple of things that I think kind of empower them. So when we think of stocks, we tend to think of stocks, they do have some volatility to them. Believe it or not, this is data back to the 1920s. You average a 10% correction in the stock market on average every year. And it's a 15% correction every 2 years and a 20% correction every 3 years. So if we think about a 10% correction in the market, and we've gone a little bit more than that, right? Depending on what index you look at, we're probably in that 15 plus 15, close to 20% kind of a correction we've had this year. But corrections are kind of a normal part of being an equity holder. So I think that's important for you to know as a stockholder that, hey, there is some volatility by owning stocks. That's why I work with an advisor like Bob and his team, because I want to make sure I've got the right percentages dialed in, and that money I need next month, I would imagine Bob doesn't have that invested in equities because he knows there can be volatility in equities. So one of the points we try to say to clients when we get a chance to talk to them is, we know things change. Financial circumstances change. They can change your long-term goals and objectives. That might change what your asset allocation might ideally look like. But we would say, don't let short-term movements in the market kind of change your behavior. We don't want, like a short-term move to kind of change your financial plan if the financial plan you put in place is really the correct one to meet your longer-term goals and objectives. So, we understand volatility. Nobody likes volatility, right? Nobody likes when stocks go down. I can tell you from a management perspective, a portfolio manager perspective, it can at times give us opportunities that we just actually haven't had in a while either. If you think about it, we're getting stocks a little bit on sale this year compared to where they've been in the last couple of years. So it could be a company that we've been looking at, we liked it, but we thought it was just a little bit overvalued in the market. If you go through these market corrections, sometimes the good companies will come in with the bad ones, and we can say, hey, we've done the work, we like this company, hey, we're getting a better entry point of where we can buy this stock. So I think it's just what I like to reemphasize is it really is it's a part of the financial plan. We are kind of the implementer of, we're the ones doing the investment side. And again, with the direction of what Bob and his team have come up with and what is the right allocation mix for this client. And then we're trying to deploy that and invest that in the best way we can see appropriate. So I think kind of sticking to your longer term goals and objectives, not letting short term swings in the market kind of derail you from your longer term goals and objectives. I think that's always kind of an important reminder to kind of think about.